Well, greetings everyone and welcome to the Argonaut monthly video covering March 2025 and the rather fruity first week of April. Well, we've seen an acceleration and a widening of the sell-off in stock markets, which began with American technology stocks in February. You can read our thoughts on other events in March in our monthly commentary, but in this month's video we are going to concentrate on the Trump tariffs and the risk of recession in the US and the global economy. Now, we've called this month's video Detox since some, but not all of the market turbulence originates from a belief in the Trump administration that they must tolerate short-term economic and political pain for longer-term gain. We're going to ask why they hold this belief and what are the implications for investors over different time horizons. On April the 2nd, President Trump announced an across-the-board minimum 10% tariffs on US imports with higher rates on specific countries, notably 34% on China on top of an existing 20% tariff. Now, American business and consumer confidence were already on the wane. Notably, the Atlanta Fed GDP now is currently running at minus 2.8%. Whilst the Michigan's Consumer Confidence Expectations Indicator has had its steepest fall since COVID, though strangely this seems to be based solely on the expectations of Democratic voters. But now the additional uncertainty created by the Liberation Day tariffs threatens a US and a global recession. So we now expect many companies to cut or withdraw their profit guidance during the imminent Q1 reporting season. And although it would be undoubtedly termed a Trump recession, there are at least two significant contributing factors that are unrelated to tariffs, whilst the risks to financial markets also manifest beyond tariffs to a more uncertain role for the US dollar and the Treasury market as the world's reserve currency and risk-free asset, respectively. When in 2022, the Federal Reserve were belatedly forced to embark on a rate hiking cycle that saw its key interest rate rise from just 0.25% to 5.5% in just 16 months, we were surprised when the equity market bottomed prematurely, in our view, in October 2022. In hindsight, a proper detox was prevented by two factors. The first, reckless deficit spending, which saw US annual federal government spending rise from 4.8 trillion pre-COVID to a current 7.1 trillion, and the launch of ChatGPT by OpenAI, which gifted the stock market a new growth narrative. When these factors are subsequently taken away or diminished, think Doge and DeepSeek, it should not be surprising that the underlying US economy and stock market is much weaker than previously anticipated and requires a lower interest rate. Now, markets are currently guessing at the pain threshold for both the Trump administration and the Federal Reserve to enact more market-friendly policies. The Federal Reserve seems currently content to sit on its hands and watch for a deterioration in the hard economic data, particularly the labour market, though it has also said that it will look through transitory tariff-induced inflation. The interest rate futures market is currently expecting 4 25 basis point cuts from the Fed starting in June. So whilst there may be a Fed put, this is at a much higher level of pain and a much lower market level. Now, the tolerance for short-term pain of the Trump administration for long-term gain has so far proven far higher than originally anticipated. In part, it seems because it's so unusual for any modern politician to have a pain threshold, but also because it seems that Trump regrets policy compromises made during his first term, but mainly because it is a defining ideological belief of the MAGA movement that America's twin deficits are undermining its economy, society, and geopolitical power. And therefore, Trump is more serious than the market thinks about reshaping the global economy and the financial system. This creates both uncertainty and risk that change will bring bad outcomes for financial assets. Tackling the fiscal deficit is easier for markets to understand and support. We've previously noted that even the most ardent advocate of deficit spending, John Maynard Keynes, would have been turning in his grave had he not have been cremated at the 7% fiscal deficit witnessed under President Biden at a time of full employment. In 2024, the US fiscal deficit was 1.8 trillion, equivalent to 6.4% of GDP. The historian Neil Ferguson has invoked the Adam Ferguson law that a great power is undermined when its debt servicing costs exceed its military expenditure. Last year, the US spent $827 billion on defense, but also 1.1 trillion on debt interest, although we should note that this law was also broken during the 1990s. Now, Elon Musk Doge claims to be targeting up to 1 trillion of cost savings, which would be 14% of federal spending. Perhaps tariffs could bring in an extra 300 to 600 billion. That's 10 to 20% of the 3 trillion of imported goods to the US. So the number of government employees rose from 21 million to 23.5 million under President Biden, with public adjacent jobs accounting for as much as 95% of last year's American job growth, according to Treasury Secretary Bessent, who has stated that the administration's goal is to re-privatize the American economy. Now, the trade deficit is more complicated and tackling it is not market friendly. But according to Scott Bessent, Wall Street has done great, but now it's Main Street's turn. So different priorities. In 2024, the US trade deficit was 920 billion, including a goods deficit of 1.2 trillion, which is 4.1% of GDP, and a services surplus of 290 billion. Now, in 1950, the US accounted for 60% of global manufacturing, employing 16 million Americans, compared to just 16% today, employing just 4 million, raising concerns about the hollowing out of America's industrial base, the robustness of its security and of its supply chains. According to President Trump, if you don't have steel, you don't have a country. Moreover, any permanent trade deficit needs to be financed by international capital flows, leading to foreigners owning more of the country's assets. In the United States, net foreign asset position, measuring the difference between US foreign financial assets and liabilities, now stands at 20 trillion. That's equivalent to 70% of GDP. So 34 trillion of assets owned abroad, but 54 trillion of liabilities at home. The risks of these assets being sold by foreigners, if they sense higher future jeopardy in holding US assets, has, in my view, been underappreciated. It seems to us that the market may be overestimating the medium-term risk of tariffs, but underestimating the political risk of holding US dollar assets. After all, if only after a few months of horse trading the US settles at a general 10% tariff across the board, then this would not be too dissimilar to the general tariff level in the EU, China or Japan. The bigger problem is that the Trump administration sees the trade deficit as a manifestation of the overvaluation of the US dollar, which itself is caused by the use of the greenback as the world's reserve currency, meaning it might not offer free use of that reserve currency in future without compensation. Now, in a seminal policy paper dubbed the Mar-a-Lago Accord, published last November, Stephen Mirren, who subsequently became chairman of Trump's economic advisors, suggested that demand for reserve assets leads to significant currency overvaluation with real economic consequences, and that as GDP grows, it becomes increasingly burdensome for the United States to finance the provision of reserve assets and the defense umbrella, as the manufacturing and tradable sectors in the US bear the brunt of these costs, and that subsequently the growing international deficit is a problem because of the increased strain it places not only on the US export sector, but with the social economic problems that follow therefrom. Therefore, this use of the reserve currency by the rest of the world becomes increasingly unattractive to America, where there is now increased appetite to change this relationship. So Mirren's policy recommendation is to resolve these tensions by a suite of policies designed to increase so-called burden sharing amongst trading and security partners, rather than attempting to end the use of the dollar as the global reserve currency. These include countries continuing to operate within the dollar system, but converting their short-term treasuries to longer-term, even perpetual zero coupon instruments in return for access to tariff-free trade and the US security system. Now, it's likely that many, if not most countries, might see this as a form of financial repression and instead take their chances outside the dollar system. And since no other currency is able to replicate the dollar as reserve currency, this might necessitate a reconstitution of the gold standard to avoid a prolonged downturn in global trade. As such, the economic consequences of the breakdown of the use of the dollar for not only facilitating global trade, but also the use of the US Treasury as the risk-free asset in the global financial system is far more serious than a reciprocal trade war.